Good evening, everybody. It's been an interesting month since we last met, to say the least, and I think we've got more fun and games ahead of us. To be honest, if we look back slightly, we had a pretty wild April for tech stocks. As you can see here on the chart on the right here, the US Tech 100 daily chart since March the 19th, down pretty hard. This was a bit of a wobble early in April. The reasons for that: higher inflation, particularly out of the US, less chance of Fed rate cuts. That sort of weighed on markets, and they were a little bit stretched as well. I think the complacency had got a little extended, and we had a bit of a sell-off. I mean, no surprise to see some profit taken there. We had some jitters over big tech valuations because we were building up to the earnings season, and at one point, Nvidia, the darling of stock markets for sure, fell just to 20%, just to keep the volatility and keeping everybody on their toes. But to be honest, we had a recovery into the end of April, start of May, and we're climbing back up. The reasons for that: it's basically post-Fed rate meeting on May the 1st. The Fed was not probably quite as hawkish as many expected, and the earnings reports out of the Magnificent Seven, and by the way, we're still waiting for Nvidia's earnings to come out on May 22nd, have been actually pretty good. Some of them were disappointing, but the forward guidance from the CEOs was quite good, hence what we've seen. So are Fed rates or AI likely to drive tech stocks in May? That's a good question. Simple answer: I think a bit of both. And with more data to come, more data to focus on, with the Fed data dependent, obviously, that is going to matter going forwards. I think Nvidia's earnings, probably a bit of both as well. So if we concentrate on the Fed to start with, they weren't as hawkish as many feared during the May 1st meeting. We saw the labor market, as you can see here on the chart top right here, that started to move down a little bit. So unemployment ticked higher, non-farm payrolls a little lower, and we saw earnings decrease slightly as well. So slower wage growth as well. But the interesting thing for me was that the other signs of the economy slowing down was the ISM services index, which contracts as business activity gauge falls. It went below 50 for the first time. That is rather concerning, and it just shows you some of this forward-looking data is beginning to roll down a little bit in the US. So I think that was a bit of a boost for stocks. I think the market took that as a bit of a Goldilocks scenario at the moment. So that was where the Fed was, but what happened in the market pricing was that markets have priced in now 2 cuts rather than one that we saw starting in December. September, maybe November, people are looking at for the first cut. But again, between now and then, we have another meeting, and also there's a lot of data to come in between there. So it's unclear, because if we listen to what the Fed says, they are data dependent. So traders have bought forward the first rate cut after the jobs report, but still data dependent, still looking ahead. May the 15th, we have CPI data, retail sales. Now, with the ISM services falling, it's critical to see what the state of the US consumer is, because retail spending now, if that data is correct, we could start seeing a pullback in spending. If we get that as well, the economy is going to start looking rather weak. So the potential to impact tech stocks later in May: firstly, what is the direction of US inflation? We need more data. Are US consumers spending less, impacting future company earnings potential? That data we're going to get as well. So, volatility in equity markets is quite low, whereas if we look at bond markets, commodity markets, and FX markets, that volatility is rising. So I'm wondering if we got a bit of a move here. There's still a bit of complacency in stocks, but what the Fed does will drive an awful lot of this. So the data is important, but these earnings have been solid. And if we look at tech earnings and AI, Tesla's numbers weren't great, but they gave investors what they wanted to hear, accelerating the development of cheaper cars. So if we look at the New York Stock Exchange FANG index, you can see this quite clearly, this quite impressive bounce. Alphabet, Microsoft, proved AI still has the potential to drive revenue and attracts money into those companies. And they are making a lot of money. There is no two ways about that. Amazon delivered, excuse the pun, on earnings and the cloud computing revenue. It's more of a tech company now than a parcel delivery service. Apple, much better than expected with data, including sales in China. So I think it was only Meta really that disappointed investors. And moving forward, earnings growth for big tech companies remains firmly in place. But just keep an eye on those Nvidia earnings out on the 22nd of May. So I think looking forward, these earnings are going to be crucial to the market. It's the biggest company out there because it is the shovels and the picks that is driving AI as well. So if you remember the gold rush, not many people made a lot of money out of gold, but the guys selling the picks and the shovels certainly did. Nvidia's like that. It's the chips behind AI, and I think this is something that is really sort of a strong base for them. Is there more competition building? I think that is possibly the case. So will they have it all to themselves anymore? I don't know, but that's a little bit further out. But I think if we look at Apple's, for instance, it's not only their company, but the sheer size of their buybacks that they're doing, $110 billion buybacks. Shareholders are going to love that, of course. Unfortunately, that means there's less money to put back into the business. And to me, the Apple iPhone has not changed a great deal over the last few years. You've got a slightly better camera with it. So, there is an issue here that shareholders are still being rewarded for holding these companies. There's no two ways about it. But I think what we need to do is see what the technical picture is on these equity markets, particularly the indices. And on that, I'm going to pass over to Richard, who's the guru on techs, and let's see what he has to say about those.
Great, thanks very much, Mo. Good evening, everybody. Thanks very much for joining us. I think certainly tech stocks and US equities in general are very interesting at the moment. But when we look at the tech sector, we can see that the index has enjoyed a fairly significant recovery of late. And obviously, once you start to see a recovery after the sort of sell-off that we saw from the March into April lows, we need to see resistance broken within that strength to develop more positive themes. And the fact that we broke last week above the Bollinger mid-average, for me, was encouraging and tended to suggest that we could see further attempts to push higher. However, I've been looking at the most recent activity as a bearish head and shoulders top. Now, the minimum objective of that reversal was met within this latest sell-off into the April 21st low, but it marked a negative shift in sentiment. And if we draw in the neckline of this reversal pattern, the rally that we've seen is only now taking us back towards the resistance of this sideways trading activity. And that is likely to slow the current advance and potentially even turn it lower to resume what is a negative trending condition still, because we're still seeing lower highs and lower lows. And if we then draw in the trend line connecting the latest highs, you can see that this rally has taken us back to this resistance point. And it's going to be very important that if this is going to become a much more sustained upside move, that we can break above this point and effectively break above that May 7th high at 18,263. While that point is intact, then the risk from a technical viewpoint is that we're still trading within this more negative pattern, lower high formation, and that the risk is that if we start to see a sell-off developing, a break back below this mid-average, which is currently at 17,804, the risks are that we could resume downside and see a much more extended retracement. And then this would bring back into play the April 21st low, and then the Fibonacci retracements of the October-March advance. So the 38% level, the midpoint, maybe even the 62% area, if this develops into a much more significant period of weakness. So we're up against resistance now, and the question is whether or not we can successfully break that, which could open the door back towards the March highs, or we start to see failure, an inability to break higher, and that turns risks lower again to test these support points. Now, when we look at Nvidia, it's a very similar picture. The market has probably rallied in a more aggressive way than the index as a whole, but you can see the same sort of type of activity in that we're still moving back towards the resistance offered by the March highs having broken above the mid-average resistance area, and that reflected a more positive tone. However, the weakness that we've been seeing develop over the last few days is a bit of a concern. And I think we still need to be aware of these retracement points, because if we continue to fail below this latest high at 919, any break below the mid-average could see us retest the April 19th low and bring about a much more extended retracement phase, even if that starts to give way. So it's certainly been a very strong and significant recovery within the tech sector over the last couple of weeks. But we are now up against resistance, and this resistance needs to give way to maintain the push higher and to open retests of the all-time highs. If those points hold and we start to see price failure again, then that could bring back into play the longer-term retracement risks of this October-March advance, and that could see corrective themes beginning to materialize.